So welcome everyone to another Success Academy recap. This is Trader Travis and I have my Success Academy co-trainer Peter. What we're going to do, well first standard disclaimers, we're just sharing what we're up to, our thoughts on the market. Sometimes we show our trades. We're not giving you investment advice. We're just sharing it for informational and educational purposes only. So what we're going to do is Peter's going to start off, look at the general market. Kind of right now we're in, well, as of this morning, according to CNBC, we hit correction territory this morning. So we're going to kind of talk about that. We're kind of drop everything else we're going to do because there are a lot of people out here suffering, maybe fearful. You want to know how we're handling it and what we think about it. So with that, let me go ahead and turn the floor over to Peter, and then I will end with my continuation of this topic I've been talking about the last couple of weeks, insuring your stock market portfolio, buying stock insurance for your 401k, 403b, any traditional retirement account, TSPs, things like that. So Peter, take it away.
Okay, thanks Travis, and welcome everyone. So little different for me today. I'm back in Connecticut and I'm freezing my butt off. So anyone in the Northeast, you know how I'm feeling. I just came from 70-degree weather. Anyway, all right. So what I have pulled up here is the S&P 500. You guys can kind of see my circles, and I've talked about this. Success Academy members would know about it. But there's one thing I wanted to just cover real quick, and I know some people will probably look at this as like, oh, he's just trying to make a sales pitch. I'm not trying to make a sales pitch. There's a lot of people that I'm sure are panicking. I know there's folks that I was just recently doing a case up in a federal prison, and one of the federal employees I talked to a lot, she was freaked out with her TSP because she saw it reduced by $16,000 in a week. So I can only imagine what she's feeling now. I tried to give her a little pause for it, but I want to kind of just cover that. What you can see on my chart here with the S&P 500, I have 3 different moving averages on. And if you're a Success Academy member, you should know what those moving averages are. Those are the 4 stages of a market crash. And we use this. It's not an exact tool, but it's a pretty good tool. We use this to determine what we can see the S&P 500 is telling us, all right? And obviously it's very easy to see now. The S&P 500 is telling us that it's going down, right? But are we going to go into a bear market? I don't know, but knowing the 4 stages of a market crash, which I was taught in the Success Academy, has taught me to recognize opportunities. Most people don't recognize this as an opportunity. There's a lot of people. Just 2 days ago, I was in the barber shop and I heard a guy sitting next to me talking to another guy, and he said, yeah, I was talking to my financial advisor and I said, hey, whatever companies we own that you think can handle a bear market, let's keep those and sell the others. And I cringed. I didn't say anything, but you should have determined that before you bought the company. But anyway, I look at this as an opportunity. And why is it an opportunity? Because most people don't listen to the really true mentors that know how to do this. I listen to people like Travis that tells me, hey, it's buying opportunities when the stock market crashes, not selling opportunities. So looking at the stock market, I'm looking at it. I'm not going to share everything about the 4 stages of a market crash because I can't do that in this time frame. But I would encourage you. And Travis, is the Success Academy still open? Membership?
Yeah, sorry, Peter. It is open until tomorrow, 10/27. So Saturday, okay. October 27th closes.
So if you didn't get into it, I highly encourage you get on if you're interested. If you're in a position today where you're a little bummed out about what the market's doing, I highly encourage, if it's not the Success Academy, go increase your financial education, because people like Travis and myself and others that would watch our video that know how the market works, they're not freaking out about a market crash. I guarantee you Warren Buffett isn't freaking out about a market crash. He uses them as opportunities. And if you look at how wealth is created in the market, this is when it's created, during market crashes. So if we look at the market, it's not looking good, right? Everyone, if you look at that 200-day moving average, that's not looking good. To me, it looks like it's crested towards the top and maybe it's on its way down. Do I know that for sure? No. So what does this say for me and what I'm doing for trading? So I closed out a lot of positions today because they were at a 90% profit margin for me. So I was able to close out of them. They were at a 90% because they were covered calls I was selling on stocks I owned. So if we look to the far right, you can see this looks ugly, right? I'm huge losses. These are paper losses. They don't bother me in the least bit. AT&T 2 weeks ago, I showed you why I'm not losing money on AT&T. It looks like I'm losing a ton of money because AT&T is at $29.50. I was telling Travis I'm chomping at the bit. I want to buy more AT&T, but it doesn't fit my plan because I'm keeping to my 20% rule. But this would have been the perfect time to buy it. However, I know I'm not losing money because that pays a dividend. QQQ, is QQQ losing money on paper? Yes. Am I worried that QQQ is going to fall out and go away? No, not at all. Macy's, same thing. I did on Macy's, I will tell you this, I exercised one of my positions. I had to do that because it's a long story, but I had to do that to be able to free up some margin so I could buy back my other positions. So overall, all the positions I covered about 2.5 weeks ago, those were all profitable for me. So even though this paper loss looks huge, in real world money, I made money over the last 2 weeks. Having said that, I'm not doing any more paper trades. So, and then on our weekly recaps, you guys won't see me do as many trades because now with the market the way it is, I don't like to, I'm already into positions to take advantage of where the market's at right now, but I also don't trade directionally because right now the market has to tell me what direction it's going to stay in. And right now it's not, it was a bull market and it's in correction territory. So I'm going to wait to see, is it going to continue down and turn into a bear market or is it going to go back to a bull market? I'll wait for that and then I'll get back into any type of directional trades, even credit spreads. I'm not in any credit spreads. I sold out my credit spreads this morning, except McDonald's. McDonald's is the only one that's still doing well. McDonald's was doing pretty well. So so that's where I'm at. That's what I think about the market. Do I know where it's going to go in the future? No. I just look at what it's telling me today, and what it's telling me today, it's going down. So I'm going to trade it's a bear. It's technically still a bull market in my eyes until it's a bear market. So I'm not trading directionally against it. If I traded a put right now, that would be trading directionally against the market, even though it is going down because it's not a bear market. Hope that makes sense. And I probably went way over my time.
Oh, I don't know. First, you wouldn't be trading against the market unless the template was satisfied for a put.
Well, right.
Yeah, there you go. And, you know, at the time, I decided, I forgot to tell you that for now, because we're in this correction territory now, that we probably could go over because people, just to kind of ease fears, worries for people. So don't worry about times. We make it as long as it needs to be. So people need us right now, so we need to be there and not, oh, we got to cut off in 5 minutes. So if you have more to say.
That's true. Okay. Yeah. Well, I mean, bottom line, a couple of things Travis and I were talking about, and we've brought this point up before, and I wanted to bring it up again. I'm writing a blog article for my JP Cashflow site, and it's kind of talking about this. Everyone knows Buffett's rules of investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. But I think a lot of people, although they know those rules, they don't really know what he's saying there. And what he's saying there is what Travis taught me a long time ago, which is it's not how much money you make, it's how little money you lose. The reality is we always make money. If you go to work every day, you make money. What you do with that money depends on whether you win it or you lose it. And what I mean by that is if you make money, you get a paycheck. If you spend a majority of that paycheck on a consumer item that gives you nothing in return other than maybe the satisfaction of watching TV or playing a game, but it doesn't give you income, well, that's losing money. And if you keep doing that, you're not going to have anything when you get near retirement. However, if you use Buffett's rules and just use the slight edge technology, if you're wondering what I'm talking about, go look that book up because it's a fantastic book. If you save none of your paycheck today, just save 3% of your paycheck every day, every week, and take that 3% and put it in something that you've done the research on that's an investment. And even if you make 1% annualized return off of the 3% you save, as long as you don't lose 1% in that annualized return, you've made money. And that's what Buffett is saying. In my opinion, that's what he's saying. That's the rule of not losing money. So when we look at trades, sometimes you guys look at our weeklies and yeah, you see big profits, but we focus on risk. The profits just happen to come because we focus on risk. We manage our losses. We don't wait. We don't sit and hope and drink from the hope cocktail, right? We manage those losses, and then you get a huge return on the other end. McDonald's, for me, on my credit spreads was losing money. Today, it's at a 54% return on my credit. Okay, if we want to put it that way. I'm at a 54% gain on the credit I earned. So if I closed it out, I kept 54%. I'm not closing it, by the way. But at one point, it was at a 9% loss, but Win was at a 80% gain. Well, I closed my Win credit spread out for a 98% gain. And now my McDonald's is at a win too. A win. So I'm actually even better off. But had McDonald's lost and gone to a 50% loss, I would have closed it out and I still would have made money. Why? Because I kept almost all my credit on my other credit spread. And that's only 2 trades. Typically, we'll have 4 to 5 based on our account sizes. So again, I focused on risk. I was focused on this is what I'm willing to risk and how I'll manage the trade so that I don't violate that rule. And it worked out for me. And when it doesn't work out for me, in the long run, it works out for me because I lose less money than I make. And that's kind of what I wanted to say about the Buffett strategy, about the Buffett rules. It's minimize your losses.
Yeah. Can I add one thing there?
Absolutely.
I had one student, he got caught up on Buffett's 2 rules. For those who don't know, Buffett is a billionaire investor, one of the world's richest investors, if not the world's richest investor. And he has 2 rules he's famous for. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. A lot of people get caught up on that and they take it literally, like they think losing money is bad. And so from now on, I'm going to translate what he really means. He doesn't mean don't lose money because even he loses money. What he means is manage your losses. Don't lose a lot of money. You have to always focus on risk first, profit second. Another way of saying it is prepare for the worst, hope for the best. And, I'll continue my example here showing you, I put math behind that so you can see what he means because not losing money or not losing a lot of money is the true secret to getting rich faster. A lot of people don't know that, but I'm going to prove that again in this week's example. First, do you have anything else, Peter?
The only thing I was just going to kind of wrap up on too is the reason why the market doing what it's doing, I don't lose sleep over it at night anymore is because number one, Travis taught me how to recognize what the market's telling me, not how to predict the market. I want to be very clear about that. I have no idea what it'll do tomorrow.
Yeah.
But I've recognized what it's doing today and what it's telling me it wants to do. So I've recognized that. That's first. Secondly, because I managed my risk, even with all those positions, those were on paper. But if I look at my real account, and I'm not going to show you my real account numbers because I don't want people to see my real account numbers. Right now, only 20% of my account is at risk. So even if the bottom fell out, I've only lost 20%, which is a big loss in some eyes. But the average person that has a 401k, if they're following the standard advice, especially the standard buy and hold advice, I guarantee 80% of their account is at risk because that's what they tell you. Put 80% into aggressive growth stocks, which would mean 80% of your account is at risk. So I don't want to lose 20% of my account, but I certainly don't ever risk more than 80 or more than 20% of my account. And when we do our options trading, we're never risking more than 10%. So even if I got caught up in this correction, it's a manageable loss because it only means I need 11.1% return to get back to break even. Whereas if I lost 50%, I need 100% return to get back to break even. So That's it. And I know I talked way too much, so I'll leave it at that.
That's good. For the times we're in, that's perfect, buddy. I'll go ahead and request keyboard mouse control real quick. And I'll touch on Buffett again. There's a coincidence. Well, no, let me ask you this. Do you think there's it's a coincidence? This will kind of give you perspective on whether you'll eventually be a successful investor. Listen to what Peter's saying. Do you see any fear in Peter's voice, any worry? Do you think it's a coincidence that the most successful investors in the world are not worried right now? As a matter of fact, the most successful ones are excited about this correction. They're buying their stocks on sale. And I listened to an interview last night of Buffett, and the lady was asking about the current volatility, and he said something. He was like, "If you're going to do," and this goes back to that barbershop conversation that Peter overheard. Buffett was like, if you're going to do something stupid, like sell your stocks when they're down, he's like, you don't need to be in stocks. And I cracked up laughing. I'm like, he can get away with saying stuff like that. If I say something like that, I'm a jerk, right? But he's telling the truth. Like, if you're selling when they're down, like, business runs in cycles. Stocks are businesses. People, he said, they're not like something you get a quote on every day. Like if you own a farm or something like that. He was like, you don't look in the paper every day and get a quote on how much your farm is for sale. He's like, business runs in cycles. And like, people forget that. Like, the market runs in cycles. It's business. No, if you've ever owned a business, some months are great, some months are so-so, some months are downright scary. Like, I'm going to make payroll. That's what the stock market is. So you have to keep that in mind. But going back to the psychology, right? If the most successful investors in the world are either excited about this market correction or not worried, then if you're not right there aligned with them, then you need some tweaking in your psychology, because that's showing you and telling you that you won't be a successful investor. So study why they're not worried. Study why they get excited during market crashes. Because if you want to succeed, you have to it's weird, you have to do the opposite of everyone else. All right. Now, moving forward, what I want to say is Peter made a comment about he only can lose 20%. So I want to recap some of the 3 portfolios I teach in the Success Academy and why myself, I'm not worried, right? One is the Family Freedom Fund. Peter hinted at it. He said the Buffett strategy. What that is the Family Freedom Fund is like a family ATM for us. It's a group of stocks we never plan on selling. If they're down, what do I care? I looked in CNBC this morning. There were all these headlines. What do I care? I'm never selling my stock. I don't care what it's at. We're going to continue selling cover calls as renting out your stock shares. We're going to continue collecting dividends. It's an asset. It's like owning a house or a piece of land or beach house is continuously passed down from generation to generation. So the Family Freedom Fund is our family ATM. It's just passed down. It's one big asset that's continuously passed down from each generation. I don't care what it's at. When it's down, I get excited. I buy more. That's because I never plan on selling. So wherever the price is at, it doesn't matter. It's not a loss to me. Okay. And another thing is that strategy, I only buy when the market is crashing, when people are selling. So all of my new money, I logged in, the market is down 10% today, or no, CNBC said it's officially in correction territory, 10%. All my new money, am I worried? No, it's sitting in cash. Like, I have no exposure. I'm not losing anything because I'm just waiting for it to get really, really cheap, and then I'm buying. So that's strategy number 1. It has built-in assurance. We're not stressed. Family Freedom Fund. Second, short-term option trading. Those accounts, the 10-minute retirement trader, I'm taking a 5-figure account, growing it to a 6-figure account, modeling the 5-year retirement plan. Okay, that's an account where Peter talked about no more than 10% of our account is out. Right now, as of this recording, my small options account, that's the highest risk account I have 2 trades open, one on Disney, one on SPY, the ETF of the SP 500. The Disney is a call option, which means if the market rockets higher from now, I'll make money. It's weird. It's tough being at Disney right now and the market's falling, but I haven't received the Nexus signal, so I'm going to follow my trade plan. The SPY is a put option. If the market tanks, I'm going to make money. So this is weird. I'm like, I don't care what the market does. I'll make money, but it's weird being on both sides of the market, but that's where my trade plan fell. I got an entry signal to buy a put on SPY, and I did. And that's why I had to come in, Peter, and I was like, well, if the template says you could buy one, you could buy one.
Right, yeah.
So that's worry number 2. Why I'm not worried is because my small account, the most I can lose is like 100. I don't care how far the market falls is 100. That insurance, the way I teach it, has built-in insurance. So I want you to think about, and then the third one is insuring your portfolio. If you're like I think the prison guard that Peter talked about, TSP is losing money. Right now, I'm in the middle of sharing a bonus training, how to insure those kind of accounts. I didn't realize people weren't using the benefit options to insure those accounts until I faced that situation myself when my mom inherited a TSP, and I was like, I'm helping her manage it. I'm like, you can't afford to lose money when you're in retirement. She's on disability. I'm like, we've got to do something about this. This is not cool. So when I solved that issue for myself, what I usually do is I teach. Okay, well, here's the challenge I had. Here's how I solved it. And what that uncovered was a lot of other people had their accounts uninsured. And so now I'm on this big push teaching about insurance. So those are the three reasons why we're not worried. So I want you to think about why you're worried. If you're worried right now, why? Okay. Think about why you're worried. If you're worried right now because the market's down a 10% correction, why? My assumption would be because you're worried about losing a lot of money. Now, that's the key. Going back to Buffett's 2 rules, let's circle all the way back to his 2 rules of investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. If you're worried right now, you're freaking out, then use that as feedback. Don't put yourself in a position to lose a lot of money. That's when I really became a better investor, when I realized I hate being worried, I hate being freaked out. So devise a system where you can still benefit. If the market rockets higher, you benefit, you build wealth. But if it crashes, you don't lose a lot of money. When you devise a system like that, during times like this, you're like Peter and I. And so that's what I want you to do. You don't like being freaked out, do something about it. Just don't sit there like a victim. Do something about it. Create a system, shore up your money so that during times like this, you're completely protected. You're not worried, because when you're freaked out and scared, you're most likely to do something stupid. And I've been there. I've sold all of my positions, watched the market take off the other way, and I missed out on it. And I felt like the biggest idiot of the decade. It happens. Or like Peter and I was talking about an older student a long time ago. I'm like, he just completely blew out his account, like broke every rule we teach. And I'm like, what were you thinking? Right? And I'm like, you know what? Forget about it. You made the mistake. There's nothing we can do about it now. Rebuild. So if you're one of those people and you just lost a crap ton of money because you were only focused on making money, you violated Buffett's 2 rules. If you're only focused on making money, you got greedy and you lost a lot of money, own that mess, right? And just rebuild, pick yourself back up and just keep going. I have empathy for you. I'm sorry for you. You can't get the money back. You can't get the lost time back, but just rebuild. Don't give up. Now, with that being said, let me go ahead and can you see my screen, Peter?
I can. Yeah.
Okay. So let me go ahead and go over this insurance example again. Now, this is the third example. This is for people who have like TSPs and things like that, which I think you should use protective put options to insure those accounts. And I explained last recap why you need an insurance. And so I'm going to zoom in here on this slide. And matter of fact, let me just turn off my camera here so you won't focus on me and just look at the slide. So Peter, did that example make sense?
Absolutely. And, can I just piggyback off of something about the whole insurance thing? So I wanted to bring up my calculator while I was hoping I would have had time. But currently, our car insurance costs us, for all our cars that we own, I think it's somewhere, I'm guessing because Tony does this, but I think it's somewhere around $250 to $300 a month. Mm-hmm. Okay? 300 times... I'm going to do 28 months. Oh, look at that, $8,400 I'm going to pay in car insurance. And you know what that insurance does? Here's the best part about that insurance that I wanted to point out. I can't call my insurance company and say, hey, I'd like to exercise my insurance contract and get the value I paid for my car. Because he would look at me like, what are you talking about? But what I could do right up to day 799, if AT&T had dropped to, let's say, $5 a share at day 799, I could call up my broker and say, I'd like to dump my AT&T stock for $32 a share. And he would honor it. Why? Because I have an insurance policy that I paid just as much as I did for all our cars over the same time frame. And that's provided I don't use all the other strategies you guys, Success Academy members see us do to pay for that insurance. Because guess what? We don't pay for our insurance. So
best case scenario.
yeah, best case scenario, right. Worst case scenario, who cares if we did pay our insurance?
Yeah.
The difference is astronomical. It's the difference between losing 20% of my account to losing 5% of my account.
Oh man.
Huge difference over 800 days. So the only thing I will say, I know people will start taking action now when you and I have been harping for the last at least 2 years to please take action now, because we know that the market doesn't go, this is actually an unprecedented bull market.
Yeah. 2 corrections in, well, first 10 years up and 2 corrections in 1 year. Yeah. It's unprecedented. Yep.
Yeah. So, I mean, a bear market was around the corner anyway, based on history, based on the history of the stock market going back to the Great Depression.
Yep.
So, and oh, by the way, the Great Depression was horrible, and the market, look where it's at today compared to where it was.
Yeah.
So, anyway, I know that went longer than I wanted it to, but I kind of, in comparison, that's the difference. You know, why would you spend $8,400 to insure vehicles and you wouldn't spend the same amount of money to insure your future? Because the vehicles aren't going to make a difference in your future, but that money will, that you just spent so hard saving up. So,
well, we know why. It's what we've been programmed to do. We've been programmed to insure depreciating assets. Your car is a complete money suck. It doesn't produce income, doesn't pay you dividends. It's a complete money suck. So you're insuring a money suck, right? Your stocks, at least, there's something that pay you. But yet we're not programmed to insure that. That's a true asset. But we're not taught to insure it. We're taught, just deal with it. No, I reject that, right? No. So that's why we're not programmed. So a mindset shift needs to happen. And I told a member in the members there, this guy was like, he had a portfolio pretty big, 6 figures. He was like, my insurance is like $11,000. And so I told him, you know, it's like your car money insurance. Yeah, if you don't file your insurance claim, you're going to lose that money. The example I just showed you, that's what people fear, losing that money. So I said, it's a matter of personal preference. I said, if you don't insure it and you lose over half your account in the market crash, you're going to lose $100,000. Personal preference. Do you want a $11,000 wow? Because he was like, wow, 11 grand. I was like, or do you want 100 grand wow? I mean, think about it. Like that's really the alternative. It's either I paid 11 grand and that's the most I can lose because my account is insured, or I don't go insurance because I don't want to pay the money. It costs a lot, and I lose over half my account. Then I have 100 grand. Wow. That's what it comes down to. But we haven't been programmed to think that way. We've been programmed to insure depreciating assets like cars. And then, our most valuable asset, our wealth building asset, the stock market, we don't insure. So, I mean, that's why. You said something else.
My last point I was just going to say, because I know Sherry watches these videos. Sherry's one of our Success Academy members, and she recently asked me why I haven't done my AT&T. I was on the fence about it.
The same thing, Sherry.
So
curious minds want to know.
Maybe this market is kind of driving home the point that Travis has taught me, even though I'm still not. I'm not losing sleep over it. Number one, I don't own the shares yet on AT&T, so. I mean, even worst case scenario, if I wanted to, I could back out of my cash secured puts. I'll lose some money, but I could back out and start over. And I could probably do that and do better. But either way, or I just suck it up, buttercup, and I buy my insurance a little bit more expensive than I was expecting, which just means it's going to take me a little bit longer to pay that insurance off, but I will have the peace of mind as well. And I don't know, maybe this was, maybe I was too biased towards, I knew I was going to keep AT&T for so long, so maybe that's why I wasn't looking at doing it, but I probably will do it, and we've talked about it.
But can I throw in some points?
Yeah.
Something to think about. Now, I'm glad you brought that up because I keep forgetting to say that. I keep talking about insurance. Not everyone needs to buy insurance. I don't want you to think you as a person needs to buy insurance. Everyone has to look at their own financial situation to see if they need it. Like if you have everything tied up in the stock market, no insurance, yeah, you probably should buy it. Peter, he just said it. Only 20% is tied up in AT&T. 80%, I assume, is in cash or something like that.
It is.
I wouldn't. I'd be teetering between buying insurance. If I was a stock I'm holding forever, no, right? I wouldn't buy insurance. He doesn't need it. Why? the max he can lose is 20 grand. And that is very unlikely for AT&T to go
20%.
zero. So if he buys insurance now, it's going to be too expensive. I wouldn't even think about buying it now. I'm not giving investment advice, just me.
No.
Here's something else to think about. He doesn't have this, but let's assume he had a 100 grand account. What he's saying is, I only have $20,000 tied up in AT&T. 80,000 is sitting cash. Okay, what if AT&T went to zero? He would lose $20,000. Well, on his remaining 80,000, he would only need to have a 25% return on that in 1 year, and he recoup what he lost in AT&T. Because we trade options, Peter can easily earn a 25% return, if not in 1 year, in 2 years. So that's another reason why he shouldn't need insurance, because he has so much in cash that even if he lost a ton on AT&T, he could use his remaining balance to recoup it with other strategies, other stocks, buy stocks like McDonald's that are going up, things like that. So, and his situation is unique. Yeah, he doesn't need insurance. I'm talking about people that are like 100% stocks, like no floor to how much they can lose. Those people worry me right now. Those people, I would be freaked out. And you need to do something about that. That would be my suggestion, not my advice, my strong suggestion.
You guys are rubbing off on me, though, so that's why I'm leaning now towards. But we talked about, and this is the other thing you guys got to think about, too, is I don't have to buy insurance to cover 100% of my position. I can buy insurance to cover 7% of my, 50% of my position. So in my case, I had 15 contracts. I could buy 7 contracts of puts.
Yeah.
Or I could just buy, instead of buying at my cost basis, which for me will be $32 on AT&T if I'm assigned.
Not bad.
I could buy my insurance at $29.
$29. Yep.
I'm going to take a loss, but if AT&T went to $5, I'm still better off.
So, I like that loss better than the loss I would take if it went to $5.
Exactly. Yeah. So I mean, we always sometimes are programmed as well as we're either all the way on the left or all the way on the right, and we never seem to come somewhere in the middle. And that's the other thing about the insurance. If you can't fathom spending $8,700 over the next 3 years, which really isn't a lot of money to insure, in this case, close to a $50,000 investment, then yeah, maybe you're in the wrong business, or maybe, I don't know. I think for you guys have been rubbing off on me, because as much as 20 grand or 20% that wouldn't cripple me or really hurt me, I'm getting more like Travis, and I hate losing money. So, and the fact is, I am being a little stupid, because you've taught me how to buy the insurance and pay for it with someone else's money. So I don't know why I'm not buying the insurance. It's so stupid. So again, though, as much as I've learned from Travis, and I'm in a 10 times better place than I was even 4 years ago, but really like 8 years ago, I was in a horrible place. I was like most people are probably feeling today. I still have a lot to learn. And that's why your financial education will never stop once you've started down that path.
Yep. Same here.
So, all right, I'm going to stop talking. Otherwise, this is going to be like a 50-minute video.
Yeah, I know. I'm done. That's been enough. Hope everyone has found some value, insurance. And if you need help, hey, just reach out. Of course, we help in the Success Academy, but we don't want to turn our back on you if you can't afford it or you're not a member. Hey, just reach out. We do our best. We have literally $3,000+ of free information on the web. It's there for you. It's nuggets. It's going to take you a while to piece it together, but it's there. All right. We're here for you. Just reach out. Let us know. If you're struggling, you need help, we'll point you in the right direction. So you all take care. Go ahead.
I learned options trading through you after the last bear market.
Oh, that's right. And it was through free course, which you made.
2009 timeframe was, I can't remember the exact date I got into it, but for those of you that might be freaking out, don't. I was in my 40s when it happened to me, and that's when I started learning options. Today I'm in my 50s. 10 years has gone by like that, and I'm in 10 times better shape than I was if I stayed where I was. So don't give up.
And because of what you learned those 10 years, you were able to retire earlier than
exactly.
Probably would have. So, that, my friend, I think is a good point for us to end on.
Okay. Thanks, you guys.
All right, you take care. All right, bye.